Good evening. Welcome to the PKF Francis Clark post-budget rural update. Thank you all for joining us on this beautiful wet evening. Certainly it is in Cornwall. It's been a terrible day. So I can't believe that in terms of the farming community, there can be much more than you'd want to do on a night like this than have a bit of a post-budget brush down. Some of you I know will undoubtedly be on your way to London tomorrow. So those of you who are going to London, we wish you luck. And we do have quite a lot to cover this evening. The budget has come and gone on the 30th of October. It was the first budget for the Labour government and one of the most eagerly anticipated for many a year, the first since Alistair Darling back in 2010. I had a week off that week and was listening to the budget on my telephone at Thorpe Park and was quite surprised about what we heard and what we saw. And since then, the phone has been very hot, to say the least. For many years, I have been, as part of my musings, talking about agricultural property relief and business property relief. And many of the budgets in recent years have been pretty mundane to that extent. But I always had felt that APR was vulnerable, BPR was vulnerable, and very valuable to the sector. And the lack of changes for IHT over recent years has generally been a good thing. We've had a very steady ship and we've been able to advise accordingly. We were aware that there might be some potential changes for APR and BPR in the budget, but I don't think many felt that we'd see some of the things that have happened and has kept us very, very busy. If we just introduce myself, I am Brian Harvey. I'm a partner and head up the agricultural team here at PKF Francis Clark, based in the Truro office. Today, we are joined by three of my colleagues. We'll hear from Dawn Peaty, who heads up our landed estates team, and she is based out of our Salisbury and Exeter offices. And she will start tonight by talking about some of the headlines of the announcements that have been made by the Chancellor, in particular in relation to the inheritance tax changes. We will then hear from John Endicott, who heads up our tax team, who will talk a lot about kind of some of the where your businesses might find itself and some of the things that we might be able to look at to mitigate some of the tax and protect some of that family silver. And finally, we will hear from Mike Butler, who is one of our agricultural partners based out of our Taunton and Salisbury offices, who will be talking to us a little bit about what we might be able to do right now and some of the planning opportunities that will evolve over the next few weeks, months, and possibly even years, as well as some other in relation to inheritance tax, as well as talking about some of the other tax implications from the budgets. We do have a question and answer session at the end of tonight's session. So if you are wanting to have a question, and there has been so many questions, everyone's situation is that little bit unique, but there will be lots of common questions. So if you do want to add to the question and answer on this webinar, then please type away, add the question and answer, and we will hopefully be able to provide the answer. Depending on the number, we will try and get through as many as we can at the end of the session. This session is due to be round about the hour mark, but I do not apologize if we do run over. Like I said, the interest in this session and other events that we've been putting on and across the sector in particular has been very, very great. And like I said, we just want to make sure that we are here to kind of give you a little bit of advice and a bit of an update as to where we are today. So if we can just click on the first slide there. By way of introduction, it is important to remember that the budget is, well, whilst Rachel Reeves stood up on the 30th of October and did her pronouncement, these are still very much proposals. This is not legislation yet. It is not expected that this will be legislation until perhaps February at the very earliest. So there is still time to potentially lobby your MPs all right. So that will be a bit of an overriding theme. But like I said, the sooner we can have that information, the sooner we can make some advice to you, and that is important. Having announcements but with no detail as an advisor is inherently unhelpful. And I said, so the sooner we can have that, the better. In terms of agricultural and business property relief, APR or BPR, we'll probably hear those terms used quite a bit in tonight's presentation. And actually, this has and always will be a very valuable relief. Even though there have been some changes, it mustn't be forgotten that these do remain very valuable reliefs for those in the business sector. There has been no changes to the qualification criteria for agricultural property relief, except actually it's been extended so that environmental land management schemes under a formal environmental agreement will now qualify for agricultural property relief. So that is good news. But overall, lots of the tests which you would have hopefully discussed with your accountant or us over the years in terms of agricultural property relief and the active farmer test and character appropriateness and all of those types of things will remain unchanged. But what has now changed is since the mid-1990s, we have all become accustomed to a world where, for the most part, there are a couple of quirky bits, but agricultural property relief has been 100% reliefable. So it qualified for 100% relief, and as a result of the budget, with effect from April 2026, this has now changed. How many people will have been affected by this budget? Well, it depends on the figures. Treasury figures suggested that only 1 in 4 approximately farmers would be implicated by this. DEFRA's own figures then have come out and said perhaps that would be more like 2 in 3. All I can say is, having spoken to Dawn, Mike, John, like I said, on the face of it, on our client base, quite a lot will be potentially impacted by this, some with a greater effect than others, but hopefully by working together, we will be able to mitigate that in many cases. Unfortunately, not all cases, but yes, we will very much look to do our best. So next slide, please, before I hand over to Dawn. There's just a couple of quotes there. There's one from Dyson to suggest that Rachel Reeves is killing off the established family businesses, and another one from Mike Sims, who says that kind of despite our assurances that small farms won't be affected, that they potentially will be. But well, I said, we've got a lot more to say on that. Hopefully we've got a bit of good news that perhaps more businesses than expected may not be hit by inheritance tax. But we will, without further ado now, I'm going to hand over to Dawn, who's going to talk a little bit about the IHT announcements and how they will impact the vast majority of people on this call. So over to Dawn.
Thanks, Brian. Good evening, everyone. I'm Dawn, and as Brian mentioned, I'm a partner in our Rural and Landed Estates team. I'm going to cover the factual changes we know about from the budget and what that might mean. Next slide, please. So what do we know? The nil rate band has been frozen at £325,000 until 2030. Frustratingly, this hasn't actually increased now since 2009, resulting in years of fiscal drag. In other words, a higher tax burden to many, thanks to rises in asset values combined with these static thresholds. The main residence nil rate band of £175,000 was introduced in April 2017. This was designed to counter the fact that the nil rate band had not increased in line with residential property values over the years, and actually this is also remaining static. As a reminder, the residence nil rate band is only available if the family home is being passed to lineal descendants and if the gross estate is less than 2 million. If you are married or in a civil partnership, you can end up with a £1 million IHT free pot. On the first death, any unused nil rate bands can be transferred to the surviving spouse. The real shock announcement was that from April 2026, agricultural property relief or APR and business property relief or BPR will be capped at £1 million in total. And assets qualifying for these reliefs over and above that cap will only receive 50% relief from IHT. Next slide, please. Thank you. So what else do we know about the £1 million allowance? Although the changes aren't set to come into play until April 2026, there are anti-forestalling measures which impact any gifts made after the 30th of October 2024. Previously, a gift would have been exempt from IHT if the person making the gift lived for at least another 7 years. However, if the donor died within the 7 years and the gift became a failed potentially exempt transfer or PET, then it would fall back into the scope of IHT. It could have been protected from an IHT liability if the APR or BPR conditions were met, both at the time of the gift as well as at the time the donor died. It's therefore important that any assets qualifying for the relief at the time of the gift continue to be used for farming or business during the next 7 years. Now, however, the £1 million cap will apply to any failed pets. We are awaiting confirmation from the Treasury that the £1 million cap will not apply to gifts made prior to the budget. Retrospective changes to tax treatment are rare, but they can happen. In this instance, we are really hoping that the old rules will still apply, as those gifts were made in good faith under the legislation that was in place at the time. The £1 million allowance is very much use it or lose it, and as such, it's not transferable between spouses. Next slide, please. On the screen now is an illustration that shows how the new rules impact a gift of an APR or BPR qualifying asset, i.e. a farm in this instance, made on the 5th of April 2025. It is important to note that after the 3rd year of survivorship, the IHT on a failed pet is tapered and is reduced by 20% for each additional year of survivorship. In this example, we are assuming that the qualifying APR criteria continue to be met. So if the donor was to die in 2025-26, i.e. year 1, the effective IHT rate would be 0%, as we are still under the old rules. However, the effective rate increases to 16% in both 2026-27 and 2027-28 due to the new rules kicking in and no taper relief being available yet. 2028-29 sees taper relief start and the effective tax rate then decreases by 20% for the next 4 years. After surviving the 7 years, the gift falls outside of the scope of IHT. It should be noted that the receiver of the gift is responsible for paying the IHT arising as a result of a failed pet. Next slide, please. Trusts have had a place in succession planning for many years, as they help to protect assets that you wish to pass down, and from a tax point of view, mean that those assets are no longer in an individual's personal estate. Relevant property trusts are instead subject to a 10-year IHT charge, i.e. they pay 6% inheritance tax at every 10-year anniversary, rather than those assets being subject to a 40% rate of inheritance tax at every change in generation. Trusts created prior to budget day have a £1 million APR-BP allowance per trust. There are many old trusts around, and these are now quite valuable given the separate allowances available for each one. However, those created on or after the 30th of October 2024 will share a £1 million allowance. It should be noted that we are still awaiting further details on the trust tax regime. We are hoping that additional information should be available in the first half of 2025. Just like for gifts to individuals, anti-forestalling measures are in place for amounts settled into trust between the 30th of October 2024 and the 5th of April 2026. Next slide, please. I've already mentioned that trusts pay tax every 10 years. The inheritance calculation can be complex. However, where the trust only held APR, BPR qualifying assets, this usually resulted in a nil liability. A lot of trusts hold assets which aren't liquid, and therefore under the new rules, when an inheritance tax liability may arise every 10 years, these trusts will unlikely be able to fund the tax bill. For this reason, the purpose of each and every trust must be reviewed. If the assets in the trust no longer need to benefit from protection from the beneficiaries, then the answer might be to appoint out all assets over and above the agricultural or business assets worth £1 million prior to the 6th of April 2026. Careful planning will be needed, especially if the 10-year anniversary is just after April 2026. It should be noted that the usual exit charges will apply to any appointments out of trust, other than in the first 3 months following a 10-year charge. However, where agricultural business assets are appointed out before April 2026, there will likely be a nil liability. On screen now, there is a table and it shows 3 examples of different values of trust that contain qualifying APR or BPR assets. So let's take the middle example where the value of the trust at the 10-year anniversary is 5 million. The associated tax liability at the 10-year charge will be 101,000. This is a huge balance to find, especially if the trustees were expecting a nil return and tax liability. I'm now going to hand over to John, who will talk you through some more of the detail.
Thanks, Dawn. Hello, everyone. As you can see from the incredibly youthful picture in front of you, dashing chap that I am, but the reality is I have been around a while in terms of dealing with inheritance tax and the rules that go back before it. And I found it fairly frustrating of late with some of the discussion on the changes. And I feel that some people aren't really understanding the position very well. So what I would like to try and achieve this evening is to try and help you understand what is proposed and how it may impact on you a bit better. So if we can flip on a slide. So I spent, this is my homework from the weekend, trying to go about it some other ways. But what I've tried to do is put together a little ready reckoner slide that I'm just going to talk you through about what kind of value of farm or value of an interest in a farm might be relevant to you and when you start to pay inheritance tax on it. I had a number of versions of this earlier on that I tried over the weekend. A number of them get very busy and very complicated. So apologies if this doesn't have quite as much detail as you'd like, but let me talk you through it. So I've looked at 4 scenarios. One is a single individual, never married. Another is someone who's a widow or a widower. So second death, husband or wife has already died. And then I've looked at 2 married couples or people in civil partnerships, and I've tried to look at one where all of the farm is owned by one spouse. And then I've looked at a situation where there's equal ownership of a farm. Okay, so that's my 4 scenarios. And then the next one we get to is, are there children or not? Okay. So as you will appreciate, this all comes down to personal circumstances and the position you might be in. And you also have to look at second death position, and what happens on a first death is relevant to what happens on a second death. So the key point here is if you've got a couple, then they're unlikely to both die together neatly, tidily. Who knows what might happen in terms of the arrangements in between and the distances. And there's a lot comes down to the will and all sorts of things, which is common to worry about in situations where you don't get 100% APR or BPR, but will have been unusual for people to have to worry about who are, let's say, farmers and expecting to have full relief. And now you just need to get your minds around it quite a bit more. So let's have a look and go through here. And the other thing is, I'm assuming there's no other assets outside of the farm. Okay, I appreciate this is all simplifying, but it's trying to help you kind of get there. So if we start off with a single person who has never married and with no children, I think they will start to pay inheritance tax if the value of their farm goes above 1.6 million. Okay. Then may be possible if they've got children to get up to about 2 million before inheritance tax is paid. So that's our first scenario. If you go on to a widow or widower, I think you're probably around the 2.3 million before inheritance tax starts to become payable on the value of the farm. You could be at 2.3 to 2.5 million, and there's a number of variables I can start to run through, but higher than for a single individual, but still probably below £2.5 million. If you come on to a married situation where all of the assets are in one of the couple's names, then you're probably much the same as that widow or widower position. So you're around 2.3 to 2.5. If you're in equal ownership of farm assets, then you're looking at something above 3.3 million, maybe 3.8 million. So you go up a long way above it. I'm going to run through these numbers a bit more for people just to try and help. But the starting message is you probably, your bottom is about 1.6 million of assets before you start to suffer inheritance tax. You could get to a position where you could be close to £4 million. Okay. Now, there is some fairly common deathbed planning. And when I say deathbed planning, I do mean deathbed. I mean day before death, or even timed, just before death. Clearly, it's a bit miserable if you haven't just got your family around there, but you've got the lawyers and people like that signing bits of paper next to you. But yeah, ignoring that point, you could get to a position where you could probably add a couple of 100,000 to those values. So you could look at a position whereby you might be at 2 million for a single person never married, maybe 3 million for a widow or widower, possibly somewhere between 2.7 and 3 if you've got it owned by one spouse, and potentially as much as £4 million if you've got equal ownership by two spouses. So you can see there's quite a variety there. And, as I understand it from my colleagues on this call, if you get into a value of about £4 million, that is covering a lot of the client situations that we may have. By no means all, but you can begin to see where some of the argument between the government and other bodies, DEFRA and the NFU, might come in here. Now, a key message to you that I want to get across is, if we had the £1 million 100% allowance, if that was fully transferable, then I think you could get up to £4 million for quite a lot of these situations. So let's flip on a minute, conscious of time, and some of you, depends how much you enjoyed maths at school, but let's try this numbers a bit more so you can begin to get it. So one of the problems is the way things get lumped together. Okay, so let's just talk through here. So I'm taking here a situation where I've got a £4 million farm, including a farmhouse, and I've got a single, all in a single individual's name to begin with, albeit married, but a single person's name to begin with, and then they've flipped it on. So we're looking here probably at a widow or widower type situation on a second death. Okay. So I'm saying that you get £1 million worth at 100%, and then the next £3 million is at 50%. So that gives you £2.5 million worth of agricultural property relief. So as Brian said, a very valuable relief, more than half the value of the farm. That leaves £1.5 million subject to inheritance tax. Now, it's important to understand inheritance tax is, it's still capital transfer tax. It was just renamed by Nigel Lawson. The rest of the legislation wasn't altered other than introducing pets. So it's a 1970s Labour tax. It works cumulatively. And what we have is 0% bands, and they are 0% tax bands. And we have those for a main one called the nil rate band, and then this funny residence nil rate band. Now, in my situation, if you've got a widow or widower, you've got two nil rate bands, let's say, so that's £650,000 coming off. They might be entitled to two residence nil rate bands, but their estate before APR is above the £2 million threshold, above the 2.7. So it gets fully clawed back. So all they've got to do to take off this is the 650,000. That leaves them on £4 million with a taxable estate of £850,000. Do 40% on that number and you get to 340,000. So in this situation, you're starting with having to find a significant amount of money. Okay, you can pay it over 10 years, interest free, that part's been confirmed. But, still a lot of money to find. But if you had an extra £1 million at 100% instead of 50%, and if you split it down in a way that you got below the £2 million threshold, which you could do, then you would get rid of that £850,000. So it is possible to plan to get to that, or we could get to a position where the £1 million allowance is fully transferable. So let's flip on a moment, and I'm conscious of time and I'm gibbering on a bit. So just recapping a bit here, because this is important and I hope people are following it enough. I think your values are typically 1.6 to 3.8 million, but will generally be around 2.3, 2.5 before inheritance tax is payable. Remember that these are values net of debt, so they're not the value necessarily of the farm itself. You may well be able to argue down those values in the way that we used to, and the old style tenancy planning that we used to use pre-1992 is likely to make a comeback, and therefore there's arrangements you could enter in to deal with that. What the value of the farmhouse is and whether the farmhouse is character appropriate will have a big difference on this, and how the new rules work on that's quite important. I can repeat only again and again, if the 100% £1 million allowance was fully transferable, that would make a massive difference. A couple of other points here. We have seen in the budget that where there was quiet lobbying on non-DOMs and carried interest, the government moved a very long way. And I think people need to understand what stance they take up and how much they try to engage with the government to get them to just move in a sensible position. The early indications are that the £1 million 100% allowance may well be fully transferable in the end, and we need to keep the pressure up to try and achieve that. Also, bear in mind there's holiday let changes that could be relevant and pension funds that will be taxable to inheritance tax. Can we flip on again, please? Just checking the timings. Right. So there are, as those of you with very high value farms or agricultural property will have realized from those early ones that, you might be a long way above £4 million. But if I just carry on more typical situations for a moment, there is quite a lot that can be done to try and make the most of those figures. So first of all, and I'm pretty sure we've got some valuers on the call, so I'll be careful how I say this. If you've got leased land, then the tenancy and the freehold reversion is generally worth less than the freehold value of the land. Okay, that may seem counterintuitive, but it's a way that works. And as long as that's been done commercially, then that doesn't get you within the gift kind of problems and the rest of it around. So that's one point. And that was the main tactic used throughout the 1970s, and a lot of the 1980s. And I spent a long time unpicking through the 1990s and even beyond. The next point is that if you've got an interest in a partnership, that may well be worth less than the proportionate value of the business. Okay, if it's only a husband and wife partnership, then there won't be any discounts applying. But if you had, mum and dad and a couple of sons, or mum and dad and son and daughter, then it might be quite reasonable to expect you might have, say, a 10% discount against the interest in the partnership. And subject to what the partnership arrangements say, that discount might be increased. So in case you're thinking, well, that's not a massive number, if you had a £6 million farm in a partnership and you had a 10% discount, that would take that down to 5.4. If you only had, 3/4 of that mum and dad's name, you're getting down to numbers where you may not have much of a liability. There are issues with what's called reservation of benefit in terms of passing on value within a partnership, so these things aren't always easy. There are also inheritance tax planning tactics to do with the joint ownership of property in terms of residential property with children. This is used commonly on expensive London properties these days, and quite a lot of planning around it. But farmers are in a very good position to take advantage of some of those rules. So where you've got joint occupation of a farmhouse or farm property, then there are rules that may well reduce the inheritance tax liability further. Let's flip on again. So couple more points from me, and just want to pick up. One of them here is about furnished holiday lets. So, we've just one of my pet topics for all of those that haven't been too bored by the joys of us going on about furnished holiday lets over the years. There are changes. There's the abolition of the furnished holiday let rules for income tax and corporation tax from April next year. We've been trying to get the government to relent on some of those, but without success. Now, that will have a significant impact on interest relief that will be restricted to the basic rate only. So this is like loan interest or mortgage interest. It will impact on the amount of capital allowances available, and it will impact on the capital gains tax reliefs. So business asset disposal relief, old style entrepreneurs relief, holdover relief, so how you gift, and rollover relief in terms of reinvestment. And there's quite a bit of planning that we're doing with clients on that at the moment. And some of you may have been on calls where I've been going on about that. An important point to bear in mind is there are no changes to the VAT or business rates rules. And if you think the government wants to have its cake and eat it, you would be right. So you can feel unfairly done by, but there you go. Now, as I say, we got a 5th edition of a book out, which goes on about a lot of this stuff and is a thrilling read if you're bored. We did push for as much clarification and to get HM Treasurer and HMRC to relent a bit on some of this. We've had some more clarification in the last few days, but not on some of the stuff we've been asking for. But in the conversations with them, we pushed quite hard and we know where they're kind of going on some of it. One of the key questions for those in the rural sector is whether you merge in the holiday lets with an existing farm business. If you do, and where it's kept separate at the moment, it's probably kept separate for VAT reasons. Therefore, you may well have an increased VAT liability. But if you did that, you probably go back to having full loan interest relief. You probably go back to having capital allowances, and you probably go back to having full CGT reliefs. And you would probably get 50% business property relief, in the same way as we're talking about agricultural property relief. So there is quite a bit to consider there for people with some holiday let activities as part of our diversified farm. And one of the conversations that we've had with a number of people is about, businesses that have diversified feeling that they've been fairly well picked on by the last couple of budgets. So holiday lets, plenty to talk about. Right, one more slide from me, if you don't mind. Thank you. So we can pick up with any questions at the end. We can pick up in further kind of discussion. But what I'm trying to point out here is that, hopefully the numbers and the scope to get to better numbers and for more farms to be protected is better than you might first have thought, and certainly better than some of the newspapers might be reporting it as. I don't think they're doing that deliberately to mislead people. I just think that knowledge and understanding of the way the rules work is limited, and it's quite hard for people to get their mind around it. And the government really should have published more detail on budget day to help people. So I think it's a failure of communication by the government as part of the budget. As part of that, we are pushing very hard to get more technical guidance on the rules as soon as possible. I have been in contact with the Treasury and the HMRC policy advisors. I finally got a call with them tomorrow afternoon. So we are as far ahead of the game as anyone can be. We've been in touch with them quite a lot. We're pushing hard on that. Trust me, we're further ahead than pretty well anyone else you can be talking to. Getting the £1 million 100% allowance fully transferable, I would say, is the number one objective that people should be on, because that will remove so much stress and complication for so many people. How farmhouses work, I won't go into the technical point here because it's too late in the day for anyone to want to go through, but that's quite important, and I'm trying to clarify that with the revenue. I think, again, pushing for more time. It's hard for any MP or anyone else to argue with comments like, you really haven't given us much time to plan for this. Bear in mind that these taxes have a 7-year tail. You pick up transactions within 7 years of the date of death. That makes it difficult in the arguments as to whether things are retrospective or not. And the argument would be they're not retrospective, it's just the way the rules work. But because of that 7-year tail, it's reasonable to say, whoa, give us a bit more time to try and get this together and transition. So I think, please consider contacting your MP personally. Don't use some standard kind of pro forma one, because it won't have the impact, but a short note saying, this bothers you. Please, can they think about it? Please, can they put pressure to give us more guidance? Please, can they help ease the burden on farms of a certain value? That will pay dividends if enough of that pressure goes on. So it is worth banging out a quick email on that. In terms of what else we can do, there is plenty that we can do to help you. clearly for a fee, because that's the people that we are, but there's plenty we can do to help you. Partnership arrangements, gifts of land or assets, tenancies, trusts, corporate structuring. There's a whole range of stuff we can do. The point is, if we can get the rules a bit better, then that takes a number of people out of needing to have to go through the aggro of doing that, where frankly it all seems a bit unnecessary and isn't going to raise much money for anyone. And please, can I just emphasize, please don't overreact. Speak to us, stay calm, just see where life is going. We're on this. And on that, I'm going to hand over to the top man, Mike, to chat you through a few things.
Thank you, John. Good evening, everyone. I'll likewise try and be as succinct as possible. We're very lucky to have someone like John on board, particularly with his links to HM Revenue and Customs. And there's a lot of work going on in the background. And I think that echoes the point that this is an evolving situation. And if we go to the first slide, because no one wants to look at me, particularly 10 years ago, the tie has survived better than I have. I'm probably still wearing the same tie, or a later evolution of it. The title there says APR and BPR and businesses. That's what we're talking about principally. Of course, I'll come on to some other budget things in a moment. But it says, what should you be doing now? And John has really hit the nail on the head. You should not panic. Whenever anyone talks about inheritance tax or the possibility of renewing their will, of course, you're thinking about what happens when you die, but it does not mean to say you will die tomorrow. You might even have a chance of outliving this government. So you have to think about that. What are our farmers saying to us? They're saying to us that these changes are complex. Inheritance tax, as one of the taxes, is already complicated, and so it takes time to digest what is going on. If everyone had wanted to give away their farms already, they would have done it. So a lot of people say, oh, should I have given my farm away before the budget? There was lots of talk about possible inheritance tax changes, but very, very, very few people actually did that. So don't feel as though you've missed a trick. And the reason why that is twofold. One is that most people would think that it's better to have held on to the farm and passed it on death, principally because they enjoy having the protection of the asset. And they don't want to put the pressure on the next generation by passing things down too early. And of course, that's the point. What is the right time? You'll be thinking about the security of the asset. Is there a chance of a claim against that asset? Could it be a matrimonial issue? Could it be, for example, a family dispute? All those things are possible. And so the idea is to use this time to understand how these rules are evolving and to then make decisions that still fit with the business need. And I think we'll come on to a couple of points about how the documentation is drawn up, working with, particularly with solicitors, to try and make sure the security of the asset is protected. So the idea of measure twice, cut once is very much the philosophy. What are people doing now? Well, of course, we're speaking to people all the time, and we're working around people. People are contacting us, and we're doing things just like this so that people feel as though they are getting information. And the key thing is you are not missing anything. If anyone says to you, you must do this, these are the exact rules, this is exactly what's happening, those people are undoubtedly sort of taking a bit of a guess. The reality is legislation is not going to come out until next spring, and things can change. So just use the time and understand and speak to your professionals. Before you start, you have to understand what your risks are, and we've talked about the mechanics of calculating tax, but of course you need to know how valuable your business is. So for those land agents and valuers on this call, and your own land agents and valuers, clearly having a firm understanding of how much your farm is worth is vital. And that's not just, you can start by saying, oh, well, I think agricultural value is this, I think agricultural value is that, but your farm will be unique. And you might have, for example, hope value, you might have all sorts of things in there that may be interesting. Some of your farm might be under solar, So you need to think about what the value of your farm is, and that may involve getting some sort of professional advice as to what the current value is, because there's no point in basing planning on, you know, what you might guess the farm is worth until you actually know really what it is worth, and you can actually map that onto the calculations. The second thing is, don't forget that we're not just talking about the land and buildings, we're talking about the value of a business as a whole. And that's an important point, because many businesses carry a lot of working capital. And whilst there may also be debt associated with that working capital, if you've got a large dairy herd, you've got a large area of growing crops, you know, that may turn into crops in the store, always fluid all the time, you've got a lot of working capital, plant and equipment. Yes, you might have some finance, but you've probably got a lot of equity in that equipment. So you need to look at the business as a whole. And as Brian said right at the outset, you mustn't assume or believe that all the reliefs that you've worked so hard with, probably hopefully with proactive accountants, to secure the agricultural and business property relief, securing those reliefs by the way in which you structure your business are really critical, and to preserve that. This is principally about the rate at which you get that relief, and so making sure you're in the game to get those relief is critical. Now, having done all that, there are a few obvious things we need to think about. Budget day was 30th of October. One of the first things we've been doing, and it sounds a bit grim, but actually going back and looking at where a client, a taxpayer, a farmer has died within the last 2 years. And those of you who will be familiar with deeds of variation will understand that perhaps there's an opportunity to review where that person's assets went under the terms of the will. And what you want to do is look at opportunities to pass assets down a generation, potentially by varying the will, if the destination of those assets is secure. So often we've got the idea that perhaps a husband left their assets to their wife, and talking about the possibility that that wife only has £1 million allowance, as I'll call it, it might be sensible that if those assets at the date that the father, for example, died, were exempt because they qualified for the agricultural and business property relief under what I'll call the existing rules, there's an opportunity to consider passing some share of those assets down a generation so as not to overload, for example, a surviving spouse who may be of more senior years. John's talked about the £1 million allowance at 100%, the APR and BPR at 100%. That until such time as we perhaps learn whether or not it might become transferable, it's clearly sensible, if the security of the asset is right, and you'll see that theme repeat in what I say, if the security of the asset is right, to make sure that everyone in the business perhaps has assets that qualify for these reliefs, APR and BPR, sufficient to use that allowance. And that may involve, for example, ensuring that a spouse has sufficient interest in land and property, as well as just the working capital to make use of that. So that's the point about the £2 million with married owners. Banking the relief on the first death. And what that means is that, of course, having split the assets, or if husband and wife jointly own assets, what you don't want to do necessarily, unless you really want to do it, which is your free will, is for the first of a couple that die to simply pass their assets back to the surviving spouse, and thereby avoid the chance of banking that £1 million allowance. Now, that could be transferring £1 million down to the next generation. It could potentially be transferring that £1 million into trust if you wanted to be a little bit more protective of the assets. So we talked about businesses worth more than 2 million, where we got a husband and wife situation. One thing we've touched on is the £4 million for a husband and wife business. That's quite interesting. And that probably is the one thing that may have opened your eyes on this call. The way in which the nil rate ban, that's the relief that's available to all taxpayers, and where applicable, the residential nil rate ban gets applied to the balance of the business after the 50% deduction for the APR and BPR has been applied for those interests valued at more than £1 million. Now, if you think husband and wife, 4 million. If you had two brothers with their wives, just as a simple rule of thumb, you might be thinking 8 million. If you got mother and father and two sons and their wives, you could be up to 12 million. Now, provided everyone trusts each other and where applicable, transfers of interests take place, and as John has said, where you gift asset survival 7 years is critical. Dawn showed you an example where getting past the 3rd year starts to deliver benefit. But in those circumstances, you can cover quite a large business. So that should be seen as a positive and something you can take away, hopefully, from this evening. So we've got gifts to children. Gifts into trust. This is an interesting point. Some people say, am I ready to make a gift into trust? Or outright to the next generation, or perhaps I make a gift into a trust where I can continue to influence the security of that asset. It's still made available to the business. And one of the areas that we're considering carefully is whether the rules will allow, for example, individuals to either use those historic trusts, which Dawn talked about. So if you have set up trusts in the past, you may well want to take advice as to how you can get maximum use out of those. And for those that haven't used trust, still the possibility that you can set up trust now and place part of your assets into those trusts. And if after 7 years pass, you've still got your own £1 million allowance and the balance at 50%. Now, when you think about trust, you have to look at the other practicalities. If you've got land secured to the bank, etc., the bank need to be comfortable with that. But on the other hand, for example, a bank that knows you're managing a tax liability, particularly an inheritance tax liability, is probably going to be actually very keen to look positively on this, because they do not want their own security eroded by virtue of unexpected inheritance tax liabilities. So if you've been used to the word trust, so you think, oh my God, run away, just think carefully and do look at the opportunities. The last thing, and we probably go on to the next slide, conscious of time. Whenever you make gifts, do always think about life cover, and you can actually get life cover to quite a late age. And of course, sometimes, dare I say it, the wife might be more insurable than the husband. Not always the case, don't want to be sexist, but it may be an age thing, all those sorts of things. Remember, if you are worried about not surviving the 7 years, you can look at the possibility of getting life cover for that 7-year period whilst the gift runs. And remembering again what Dawn said, after the 3rd year, the exposure to tax starts to decrease. So that life cover can also decrease just at an age, obviously, as you're getting older and the risk increases. And therefore, that's a way of perhaps keeping the premiums down. John has talked about value destruction. Now, that sounds pretty grim, but for once in your life, you might be wanting to devalue your assets. So we're talking about you breaking up the interest perhaps in those assets so that you've only got part interest. So if 4 people own land together, their individual interest is unlikely to be valued at a quarter of the whole, mainly because of the inconvenience of the fact they do not control and own the whole of the asset. Looking at shares, if your shares are restricted in terms of who they can pass, that can have a devaluing effect, as can that same principle of having a minority interest. Likewise, freezer shares. So sometimes the older generation may not necessarily want to have a large share of future growth in the business. Business growth is generally driven out of profits, and I know profits are difficult at the moment, but you might have a different class of shares for the next generation from this point on that capture the majority of the growth in the business, therefore not making the older generation their estate too onerous. With partnerships, for example, we talked about spreading assets across family members, partnership agreements. So starting off, there are still lots of partnerships without partnerships agreements. It's incredible. But dealing with professionals, the fees associated with the time, you're all very busy. There has never been a more important time to have a robust partnership agreement, not only to be clear exactly what and who own the assets and what are partnership assets, but to protect those assets, perhaps by having terms within that partnership agreement which restrict the ability for any one partner to cash out and put pressure on the business, or undue pressure on the business. So it may be the time over which someone's paid out or how the assets are valued. Pre and post nuptial agreements, that's a real legal point, but I suspect those solicitors dealing with that aspect are going to be very busy with this. And wills, of course, if you pass assets down, for God's sake, make sure those that receive the assets in particular, but also those giving, update their wills. It would be catastrophic if you pass the assets down and the person to whom you pass them does not have a will. Dying intestate is not, or does not have an outcome that you would normally expect. For example, all the assets do not go to the surviving spouse. Some people talked about incorporation, and again, the classification of shares. If you do have a company, then looking at how different classification of shares can alter the value, and that might be to do with the voting rights or the rights to capital if the company is wound up. So moving on to the next slide. I'm not going to speak about IHT anymore because you're probably an IHT overload, but what I hope you can see is there are some real positive opportunities to look at your business, take good advice, don't panic, and you'll probably find that you'll be pleasantly surprised with the outcome. This is not going to please you at all, because of course the budget dealt with many areas, including spending, the agricultural budget going into DEFRA. BPS is being cut drastically next year, and so it's going to be based on 24% of the claims made in 2020. So looking at the delinking, but worse than that, if you were a large claimant, £30,000 or more back in 2020, it's going to be cut to a maximum of 24% of that figure, so only 7,200. Now, as we go into different parts of our region, east and up into the Cotswolds and further north, some of those businesses were admittedly claiming, hundreds of thousands of pounds. To get £7,200 is going to be dramatic. The conversation today is not what that's going to do for land prices and rental values, but that's going to be a significant hit to cash flow. So doing budgets and forecasting, speaking with your bank, and then looking at the last point, what are you going to do to try and replace that money? Because reportedly we are still going to have the same money in the agricultural budget, but there is a spending review taking place in the new year. I won't try and speculate what that is, but clearly you're going to need to, unfortunately, spend as much of your time trying to work how you replace the basic payment as you are going to plan for your inheritance tax, because you still need a viable business to keep going. We'll go to the next slide. There's the graph showing, you can see it drop away 2025, that significant drop as it converges towards a best part of nothing, I'm afraid, maximum of 7,200. So you can look at those examples where someone started with 100,000 basic payment in 2020. It's just a difficult story, but you need to look at how you're going to replace that income and that money. We'll go to the next slide. And I'm going to finish with the old nutshell, the double cab pickup. Excuse me. And basically, the revenue, having had a first attack on them as a result of a Coca-Cola case to do with vans and pickups, there was an about turn probably about 10 days later, and I'm talking probably about 8 or 9, might even be 10 months ago. They have now legislated that double cab pickups specifically will be treated as cars for the purpose of tax. Now, that is difficult for farming because, of course, a lot of farming scenarios, you do carry around people, you carry around tools, etc. It is a difficult one. So we're talking about double cab pickups. We're not necessarily talking about commercial vehicles and vans here. With a double cab pickup, if it's not a van, private use, for example, if your business provides the vehicle for you, if you run as a company and you're a director or an employee, even home to work is going to get it caught because it's not a van. With a van, home to work is typically okay. But once you start using either a van or indeed a double cab pickup, With a van, you still got the van benefit. With a double cab pickup, you will be treated as a car. And because the emissions are generally not great, and looking at the list price of those vehicles, the tax will be onerous. I'm not going to talk you through an example, but this will apply to double cab pickups that are acquired by the business after the 1st of April 2025. So any vehicles you've got pre-existing will be able to continue under the old rules. You can see that it's going to possibly have a big impact on the double cab pickup market, and if you've got one to sell, you might find it quite difficult to sell. We believe, although of course it's such a grey area, if you have a 2-door pickup but with a second row of seats where there is a purpose of taking people around, it's likely that that vehicle will also get caught under this regime. And to be quite honest, you know, they're probably not particularly practical because of the restriction in size. We'll just go to the next slide, because that is just referring to that. And you can see there, if you had a list price vehicle of £40,000, because of the emissions, you're at the maximum 37% benefit in kind of that 40,000, which would mean the benefit of actually being provided that the vehicle goes up to 14,800. So that's a significant rise in tax to have the privilege of having a double cab pickup. So perhaps people will move back towards things like Land Rover commercials, etc. I think that's from me, so you can probably go on one slide and hand back to Brian, who's going to talk you through some of the other nuances as we approach the end of our journey.
Thank you, Mike. Thank you, Dawn, and thank you, John, as well. Hopefully there's lots to think about, lots to talk about. If you do have any questions, then do please put them in the question box on the webinar. Like I said, we've got 8 or 9 questions we'll go through in a minute, but like I said, there is still the opportunity to pick our brains and to answer some of the questions. Like I said, we will come through them in a moment or two. If we just want to click on a slide, please. Just a couple of other bits and pieces in the budget that are not specifically related to farming, agricultural, landed estates, but would be potentially of interest. So click on another slide. In terms of capital gains tax rate, what's that mean in the budget? Essentially, with the immediate effect, we no longer have different capital gains tax rates for residential property and shares and non-residential property. So prior to the budget, basic rate of capital gains tax on shares and non-residential property was 10%, main rate 20%, whereas residential property that was 18% and 24%, with effect from immediately from the moment that the Chancellor sat down. We were at one rate, 18% basic rate, 24% main rate, and that's going to be the case for the next 2 or 3 years. One bit that quite a few people didn't probably pick up, but is quite relevant. In terms of if you were selling a business and it was a trading business, there's been something that used to be called entrepreneurs relief, now called business asset disposal relief, and over the years it's been tinkered with quite a bit. The amount of gain you could actually offset against it has come down, but it's been a 10% tax rate. Quite a lot of people have tried and have successfully taken advantage of that 10% rate being a very relatively low rate. You'll see that that's still the case for any disposals for now, but from the 6th of April 2025, that goes to 14%, and from 2026, it goes up to 18%. So essentially everything is to be taxed at the basic rate. So if you are looking to dispose of your business and the timing is right, whether that be a farming business, furnished holiday lets, we're seeing quite a lot of that, as John has alluded to earlier, then a disposal before the 6th of April can lead a 10% tax charge, whereas that is only going to go up and it's only going in the one direction. So something worth noting. If we move on to the next slide, which is one that a lot of people on this call will employ, many people. This one's been talked about quite a lot. The increase in employers' national insurance, obviously with the triple lock, not to increase some of the other taxes, the government were going to a little bit of a fight with one hand tied behind their back, and the one tax that seems to be most heavily raised to raise the revenue and to close the gap has been employers' national insurance. So essentially, two things. One which was probably more widely expected was the rate was increased from 13.8% to 15%. As I say, that was quite widely expected, an extra 1.2% per person. What was probably less expected was that the threshold was reduced from 9,100 to £5,000 per person per annum. So therefore, very many part-time, lowly paid individuals were now getting caught by employers' national insurance. The implication of that is for every employee who earns £9,100 or more, the cost of employment was £615 more per employee, plus 1.2% of the salary. So like I said, but for many businesses, that could easily be costing an extra £1,000 per employee. The only saving grace is that for some smaller businesses, of which farms may well be in this, the employee allowance has increased from £5,000 to £10,500. So some will fall below that. But like I said, many medium-sized businesses, probably businesses that would employ roughly 8 to 10 people or more, will see some significant increases to their employers' national insurance, and that at the same time as a rise in the minimum wage just makes employing people that bit more expensive and puts pressure on people's margins, and yeah, just is another thing to think about at this time. The final kind of technical slide, if we move on, is pensions. I'm not going to talk too much about pensions other than historically, pensions have been a very safe environment in terms of inheritance tax relief. Have been largely outside the scope for inheritance tax. The Chancellor announced that from April 2027, unspent pensions will come into the scope for inheritance tax. We're waiting on some of the implications and some of the detail, and that will give our financial planners and many people who have pensions a lot to think about. And whilst many people's pensions in agriculture is the land, is the farm, there are people with pensions, there are people who own SIPs which have pensions, which could well have land or agricultural buildings in them. How that then turns into cash to pay tax bills, where there's literally no liquidity or very little liquidity, is interesting, and how that may interact with APR and 20%, 50% or 100% is all. There's lots to think about. Like I said, it's a very much watch this space, but people's pensions will be impacted by this, so we need to keep a close eye on that. So just before I go to a couple of questions, I think it's worthwhile mentioning kind of what we're doing at the moment. If we just move on one slide. So as a agri and landed estates team, and as a firm in general, we are trying our best to lobby. As I said, John particularly has been successful in the past with this, and we're trying to engage with HM Treasury, engage with MPs at a local scale, as you might expect, working alongside the NFU, the CLA, the TFA. We, as a agricultural team, are members of the RAG group, which is a rural accountants group, which is a nationwide group. So we are working with our friends from other firms across the country to see kind of how we might be able to work together, and that's working well, as well as other professional bodies. In terms of a compromise, potential easy wins, I don't want to disappoint people. I know that there are many thousands of farmers going to London tomorrow to kind of stick up for the industry, and good luck to all of you. But in terms of expecting what is a likely outcome from this, I think if we think that any changes to the inheritance tax rules were completely rescinded and returned to 100% relief, I think that we are probably misguided. I think that is extremely unlikely. What we are hopeful for and looking for are perhaps some more easy wins. We've talked a lot already about making the transferable £1 million 100% agricultural property relief, and make that automatically transferable between spouses. Maybe the limits of £1 million could get increased. Looking at phasing, I mean, one thing that is probably the most unfair thing about the inheritance tax rules is that, as we've heard today, for most people, if you've got 7 years survivalship in you, with some decent planning and some luck and potentially some life insurance, then we can mitigate some tax and protect some family assets. But for those elder members of the agricultural community, or perhaps those who are already in a situation where they're perhaps suffering from dementia so that they can't make changes, it is very difficult to see a situation and potentially some horrendous conversations that have already been having place, and I do worry about perhaps the mental health, unless I think that's as an industry something we need to think about. So as I said, there are hopefully some easy wins, perhaps some kind of phasing of making 7-year gifts might be acceptable, or even just an extension as to when the legislation might come into place would be helpful to that regard. Finally, onto the final slide, please. What are we doing? So we're spending a lot of time talking to our clients and to other professionals. Like I said, I don't think in all of my years in the industry, my phone has ever been hotter. Seems to be certainly more than 9 till 5. I think it's probably 24/7 at the moment, and it's almost as if I need a recorded call, a recorded message as to kind of where we are and what we're thinking. I think there will, as we said, hopefully the message you've got across tonight is that there will be planning opportunities, and you do need to work with the likes of us, and we hope we can improve the situation. Like I said, unfortunately, there isn't a silver bullet. We won't be able to help everybody, but I think for the vast majority, hopefully things can be done. And I think at this point in time, we hope that as more information becomes available, we will be putting out further blogs. Maybe we're doing another webinar in the future, depending on what the response to this one is. But if people have enjoyed it or think it's been worthwhile, then we're happy to perhaps do something again. But as I think all of us have said, the important thing now is not to overreact, not to do anything silly, rash, but to kind of keep calm and carry on. And like I said, over the next few weeks, months, and probably the next 12 months or so, kind of hopefully we can come up with some sensible suggestions, and kind of everyone will feel that little bit happier. So I think that concludes our main presentation. Sorry, everyone's just over the hour. In terms of questions, we've got quite a lot of questions here, but I wanted to start with a question which I've had emailed to me, so it's not actually in the questions, and it's probably one well for either Dawn, Mike, or John, really. Today we've talked about £4 million. Why has the Chancellor always talked about £3 million in terms of the amount which farmers can pass on tax-free? Anyone want to answer that question? John, do you want to answer the question between why is the Chancellor adamant that it's £3 million when we think it could be a bit better than that?
Well, I don't think they're very familiar with the rules or understanding it, and their answers are being quite flaky and odd, full stop. So yeah, I'm not sure I can say a lot more other than it's just all a bit weird.
No, that's fair enough. But like I said, hopefully, like I said, £4 million is a step in the right direction, and we'd rather it would be £4 million than £2 million, I guess. So
I think I was going to say, I think it's and also I think it's based on the way tax is calculated and the fact that a lot of the rules haven't changed, but not many people understand the rules that were there anyway. So, when you get people latching on to things, it's like everyone says, is the tax rate 20%? I thought the tax rate was 20%, people will say. And the inheritance tax rate is still 40%. It's just that for a lot of your business interests, you may only pay tax on half of the value of the business, the half in excess of the million. And so there's an effective tax rate. So the Chancellor did use the word effective tax rate at 20%. But when people say, is it not that businesses only attract 20% inheritance tax, that's such a broad generalization, it sends you down the wrong rabbit hole. So I think there's a lot of situations where people don't understand how the rules are calculated. Now, if it happens that we believe that 3 million is actually 4 million, then we'll take that. If it's the other way around, we'd probably get more agitated.
No, perfect, thank you. One question that came in very early was, will forestry be treated the same as agricultural land?
Brian, I suspect some of these questions might be for me, but just on forestry. So forestry is typically picked up under agricultural property relief or business property relief. And if it, to that extent, yes, it is impacted, but there is something called woodlands relief as well, which is less generous than APR and BPR and is more of a tax deferral, but that is not caught by the restriction. So, Matt was asking that, and I'm glad he's on here, and I'm glad he's managed to. I hope he's found a call worthwhile. But there's a more complex position to think about, and it will depend what people are doing with their land as to how relevant that is. So plenty of scope to talk to us in more detail.
Yeah, there's a couple of comments about will the slides be circulated. I think the intention is for these slides to be circulated, and I think this will also be recorded. So I think if people have missed out tonight, they'll be able to listen again. I expect us to be top of the charts by the end of the week. There's a question there. Is the transfer of assets still IHT free between spouses on first death under the new rules, or this is capped at £1 million?
And the answer is yes, it's still, the spouse exemption is still there. There is, I think, Brian, somewhere else a question about saying on a first death, can you transfer 1 million to the next generation, transfer the rest to the surviving spouse, and then on the second death have a further £1 million allowance? So it's probably worth picking that one up at the same time. So the point is, you could leave everything on a first death to the surviving spouse, but if the allowance isn't transferable, then you would waste £1 million. So what you're going to be forced into doing, on the way the rules are written at the moment, is to do a trust or a gift on the first death to use up that £1 million in the same way that you had to before the nil rate ban became transferable in late 2007. And that is why it seems a nonsense that it's not transferable, because it just creates an industry of having to go into planning to do it. So logically, you would want to utilize it on a first death unless it becomes transferable, and then life gets easier. Hopefully that's answered both of those.
Yeah, I think that has. Thank you, John. The final question there is it worth transferring any traditional buildings that have potential for PP out of the farm ownership into a company if the bonds are worth about 400,000? If that is the case, how long would the parent have to live as a director to avoid IHT?
Yeah, so I sorry if I just pick up on that. I've thought quite a bit about what you do with development land or where you've got potential kind of opportunity, and I think that's one of the more tricky bits for certain people in some locations. And I think so this goes off in a slightly different direction at the end, this question about how long you have to live. I'm not sure you've got to live particularly any length of time at all, because it would be a commercial transaction. What you're trying to do is you're trying to get an asset out at its current value before you think it's going to go up in value more. And therefore, if you think you've got assets that could go up a lot more because they might get zoned, or you think you could develop barns, then yes, you probably want to look at trying to get them out of someone's estate. Quite how you do that, I think, is one to pick up, with whoever's the appropriate person from us to talk to.
And fundamentally, not a lot has changed in terms of might be looking to do that in any case. So
you might have been, but don't forget that the business property relief was unlimited, not restricted to agricultural value. So you probably would have done if it was you relying upon agricultural property relief. But if you were getting business property relief because it was a working farm, you'd probably gone, doesn't matter. Whereas now suddenly it matters, really.
Yep.
I was going to just say, Brian, I don't know whether just briefly, I know we haven't emphasized it, but in my comment, measure twice, cut once. Firstly, when you consider gifting assets, you need to always remember capital gains tax. So whenever you're giving assets between connected persons, i.e. typically family members, you need to make sure that you don't trigger a capital gains tax, or if there is a gain on the asset and you don't want to pay capital gains tax, you can, for example, hold over the gain, which is not available on all assets. So just take advice on that, because before you even get to survive the 7 years, what you don't want to do is have an capital gains tax charge on the event of a gift, and that can include property and shares in a company if, for example, that company has elements that are not purely trading. The other thing is, whenever you make a lifetime gift of an asset, you are obviously then, for that gift, out of the game in terms of what we often call tax-free uplift on death. And so just be aware that you know, whoever receives those assets are likely to take on those assets at the lower historic capital gains tax base cost if you have held over the gain, which is one of the points which is a concern if you rush around and give away assets. What you're not doing is washing out any historic gains, which can be the case, for example, where people bought land with rolled over money. When they die, they expect that gain to have died with them. That won't be the case with lifetime gifts. So take that advice.
No, absolutely. And like I said, don't assume holdover relief is automatically available on 100%, because it can come back and bite. Just, does debt reduce the valuation? I can confirm that the debt would reduce potentially the valuation, obviously, in assessing someone's estate values, and if there is debt. Interestingly, historically, I guess if that debt was offset against an asset that was qualified for 100% agricultural property relief or business property relief, it probably made little difference, or maybe, but now that will become more significant. And then as a final question, and it's one that I think I've heard a few times, and I think it's for John. It's more about the coming back to the gift with the reservation of benefit. If you'd like to gift something away, but if you need to rely on that income stream for latter life, whether that be for normal life or perhaps care home fees or the likes, how easy is that to be achieved, or is that something we need to take extreme caution with?
Well, it's something you need to take caution with, but there are ways of doing it, and it's all about planning ahead. So there's a couple of tactics you can do, and thank you very much for all the good points you were making in that last discussion. But there's a couple of things that you can tend to do. One of them is that you might want to leave someone with a current account that they can draw down on, so that, you know, Brian's got a current account of 100,000 and he draws £10,000 a year to kind of run it down. You know, clearly that's planning on how long you might survive, Brian. You know, and there's a kind of point as to how to kind of use it. But you can do some modelling there. But you could probably look at annuity arrangements, for instance, from partnership. You know, there's some other things you could think about. The danger is that we end up complicating the lives of people who, frankly, don't need the complication. Do you see what I mean? You know, so it depends.
Absolutely.
It depends what situations we're in, but I would say there's stuff that can be done. It's all about kind of planning ahead.
Yeah, and using the term Brian and modelling, they're not two words that go together very often, John. So we like that. Now with that, I think that probably concludes the questions for this evening. Thank you all for joining us this evening. In particular, I also want to thank our three key speakers. So Dawn, to John, and to Mike. Thank you for giving up your evening to talk to us tonight. There is clearly still lots to think about, lots to talk about. There isn't one size fits all answers. You do need to talk to us, and we will be trying to talk to you as well. But do also at the same time do bear with us, because as you can imagine, we've got quite a lot of clients who have quite a lot of similar issues, and we're trying to deal with that in a kind of in a way that kind of works for everybody. And certain people's situations, particularly those who are kind of most vulnerable or most elderly, may be more pressing than perhaps other people. So we do, like I said, do bear with us. We were doing our very best, and like I said, to look after our clients and their needs. Like I said, well, I hope you can go and enjoy a nice supper. And like I said, if there are any comments, any feedback, then do come back to us, and we look forward to speaking to you in due course. Thank you for your time.